Saxon country, and other funds popped up in Scotland in the 1880s. The idea of pooling funds from many investors to buy a diversified portfolio crossed the Atlantic in 1893, when the Boston Personal Property Trust became the first mutual fund in the U.S. 1928 was a big year for fund innovation. The firm of Scudder, Stevens, and Clark launched the first known no-load fund that year. That meant that investors didn't have to pay an upfront fee. The first mutual fund to hold stocks and bonds instead of merchant banking investments, the Wellington Fund, got its start in 1928 too. During the Great Depression, the federal government began to regulate the mutual fund industry. The Securities and Exchange Commission was formed in 1934, and mutual funds were required to register with the SEC and to provide a prospectus. The regulatory web got tighter with the Investment Company Act of 1940, which added more disclosure requirements and took a stab at the worthy goal of reducing conflicts of interest. In the year 1971, two guys from Wells Fargo Bank broke the mutual fund mold. William Faust and John McCowan established a $6 million fund for the Samsonite Corporation's pension program. Their revolutionary idea was that this fund wouldn't try to beat the market. These guys weren't interested in running up transactions costs trying to pick winners and losers. They wanted to match the market return while paying rock-bottom expenses. They didn't even do any security analysis. They just invested an equal dollar amount in each of the 1,500 or so stocks comprising the New York Stock Exchange Index. That way, they earned what the market earned and paid lower transactions costs than other funds paid. Investing hasn't been the same since. Because mutual stock funds hold a diverse collection of stocks, their returns typically track the stock market. They produced amazing returns during the sustained bull markets in the 1980s and 90s. People took notice and mutual fund investments hit record highs. With the exception of a few years around market downturns, mutual funds have been growing ever since. We can classify mutual funds along several dimensions. Some mutual funds invest in stocks, while others invest in bonds. You may have heard of money market mutual funds. I tend to think of those highly popular funds as a special class of bond funds that invest in very short-term debt securities, such as treasury bills or bank certificates of deposit. We'll focus on stock funds, which invest primarily in stocks, keeping just a little in cash and short-term assets to enable redemptions and other needs for quick cash. You can further partition stock funds into domestic stock funds and international stock funds, which consist of global funds, international or foreign funds, emerging market funds, and probably a dozen other types. The definitions of these funds aren't etched in stone, but typically a global fund invests anywhere in the world, while an international fund, sometimes called a foreign fund, excludes the fund's home country. The definition of an emerging market fund is fuzzier. First, you have to define an emerging market, and reasonable people will disagree. Generally, though, these countries tend to be poorer and rapidly growing with more political and economic uncertainty. Emerging markets funds usually offer the potential for higher returns, but obviously higher risk is part of the bargain. Still, another way to classify mutual funds is by their investment policy. Each mutual fund has a stated goal, often depending on the amount of risk they'll take in search of higher returns. Among the most popular categories, income funds, which hold a lot of mature companies that pay big dividends but don't offer much hope for big price increases, are the safest. Growth and income funds come next, then growth funds, and then aggressive growth funds are the riskiest. They tend to hold stocks in smaller companies, companies that have fallen on hard times but hold some promise for a big recovery, and companies in risky industries like biotech. You can also classify mutual funds as taxable or tax-exempt. Most tax-exempt funds hold lots of municipal securities. You won't find a tax-exempt stock fund, but some explicitly state that although